Hello everyone, this is Mr. Vanderpool. Today we're going to move on to some international trade, and we're going to be talking about something called the balance of payments, which takes a look at the outflows and inflows of money and capital between countries. Alright, so what are the balance of payments? As previously mentioned, they are the measure of money inflows and outflows between the United States and the rest of the world, which we will go ahead and call ROW. So a couple key things to remember. So inflows are referred to as credits, okay, whether it's an inflow of money or capital, whatever it might be. Inflows are credits. Outflows from a country are debits. And the balance of payments are divided into three accounts. You've got the current account, which refers to when you're talking about net exports, you're talking about balance of trade. You've got the capital financial account, which is when you're looking at the balance of capital ownership and the ownership of financial assets. And you've got the official reserves account, which looks at holdings by the central bank. In the United States, that is the Federal Reserve. Alright, so some key things to know and key things to remember as we talk about the balance of payments. Number one, if you have an inflow, it's called a credit. If you have an outflow, it's called a debit. Okay. What we're going to be doing is we're going to be looking at scenarios. We're going to be classifying them as debits and credits to various accounts. So it's important to understand when we're talking about current account, generally we're talking about exports and imports. When we're talking about the capital financial account, oftentimes when we're doing the scenarios, they will involve factories and or stocks and bonds. And the official reserves account will refer to the Federal Reserve doing stuff. And another equation to remember is the current account plus the capital account plus the official reserves account adds up to 0. They clear each other out. Alright, so let's talk about double entry bookkeeping. So every transaction in the balance of payments is recorded twice in accordance with standard accounting practice. So for example, a U.S. manufacturer, John Deere, might export $50 million worth of farm equipment to Ireland. So that's going to be a credit of $50 million to the current account. Okay, we're looking at an export here. We're looking at John Deere is exporting a good. Okay, they're sending out the good, they're bringing in the money. Okay, that money is under the current account. So basically what's happening is you have an inflow of $50 million in this current account. Okay, so you're going to have a credit or an inflow of $50 million to the current account. You're going to have a debit of $50 million to the capital financial account because John Deere from the United States is giving up, or there is an outflow of $50 million worth of capital. So we have a debit of $50 million to the capital financial account. So the credit of $50 million to the current is basically saying you're having an inflow of $50 million to the current account. The debit is an outflow of $50 million worth of capital to Ireland. So notice that the two transactions will offset each other. Theoretically, the balance of payment should always be equal to 0, theoretically. Luckily for you, in AP Macro, we only worry about the first half of the transaction. We're going to simply see the export of farm equipment as a credit or an inflow of money to the current account. So go ahead and just keep everything simple. Go ahead and just do the first half of the transaction as we're going through these classifications in AP Macroeconomics. Alright, so next we're going to go ahead and take a look at the different accounts. Alright, so let's talk about the current account. In the current account, we're focusing on money inflows and outflows. So an inflow is going to be a credit to the current account, And an outflow is going to be a debit to the current account. And if you have a money for money transaction, the party that is bringing in the foreign money is actually going to have the credit. All right, and so there are various things that are under the current account here. The biggest chunk of the current account is going to be in the balance of trade, or net exports, which of course is the exports of goods minus the imports of goods. So exports are going to create a credit to the balance of payments. Particularly, they're going to create a credit to the current account. And here's why. Because you are giving up the good, but you are bringing in money. And this current account is focusing on the money inflow here. Because you have an inflow of money, it is going to be a credit to the current account if you have an export. Imports is going to be the opposite. It creates a debit to the balance of payments, because what we're doing there is we're bringing in the good, but we're giving up the money. So it's an outflow of money. So it's going to be a debit to the balance of payments, in particular to the current account. So inputs are going to create a debit to the current account. You've got net foreign income. So income earned by U.S.-owned foreign assets minus the income paid to foreign-held U.S. assets. Okay, so you would have the interest payments on U.S.-owned Brazilian bonds. Okay, those are going to create a money inflow, which is going to be a credit, minus interest payments on German-owned U.S. Treasury bonds. So here, the United States is going to be paying the Germans. In that case, that's going to be an outflow, and thus it is a debit. So the first half of that transaction is going to be a credit, minus the second half, which is going to be a debit. You also have net transfers. Now these do tend to be unilateral. So foreign aid is going to be a debit to the current account, because with foreign aid, money is leaving the nation to go to a foreign nation. So it's an outflow of money. So it is a debit to the current accounts, and because in the current account we're looking at those money flows. And an example might be a migrant worker sending money to his or her family in Mexico. Once again, it's going to be a debit to the current account because it's an outflow of money, and that money falls under the current account. All right, let's go ahead and take a look at the capital financial account. This is going to look at the balance of capital ownership. We're looking at the inflow and outflow of capital, of factories, of tools, etc. So it includes purchases of both real and financial assets. So real assets are going to be things like what I mentioned previously, factories, tools. Financial assets are going to be things such as stocks, bonds, etc. So direct investment in the United States is going to be a credit to the capital account because it is an inflow of capital. So for example, if you have a Toyota factory in San Antonio, okay, San Antonio of course is in the United States, so you have a Toyota factory there. Because Toyota is a Japanese company and it's building in the United States, okay, it is going to be a credit to the capital account because there is an inflow of capital in the United States. If you have direct investment by U.S. firms and individuals in a foreign country, that's going to be a debit to the capital account because you are having an outflow of capital in the United States. So Intel is an American company. If it makes a factory in San Jose, Costa Rica, then that is going to be a debit to the capital account, capital financial account, because it is an outflow of capital. So if something is built in the United States by a foreign nation, it is a credit to the capital account. If something is being built in another country, it's going by an American company, it's going to be a debit to the capital financial account. All right, let's go ahead and take a look at the financial side here. So the purchase of foreign financial assets represents a debit to the capital account because there's an outflow of assets. Okay, financial assets are going to be leaving the nation there. So if you have Warren Buffett, famous American stock trader, he buys stock in PetroChina. He's buying stock in another country. It's an outflow of those financial assets. Thus, you're going to have a debit to the capital account. If you have the purchase of domestic financial assets by foreigners, that represents a credit to the capital account because it's an inflow of financial assets. So if the United Arab Emirates, their sovereign wealth fund, purchased a large stake in the NASDAQ, okay, that is going to be a credit to the capital account because there is a large inflow of financial assets. So if an American buys stock somewhere else, that's a debit to the capital financial. If you have a foreign nation that's buying stock here, that is going to be a credit to the capital financial account. Now, next we're going to look at what causes capital and financial flows. So what we're going to look at here is we're going to take a look at two countries and their loanable funds graphs. So we're going to look at China, and we're going to go ahead and look at the United States. China's to the left, United States is to the right. As you can see, in China, the real interest rate is lower than it is in the United States. So that's going to cause the Chinese to want to go ahead and move their loanable funds over to the United States. So they're going to take their savings, and they're going to go ahead and move them over to the United States. So we have a decrease in supply of loanable funds for China. So the difference in interest rates of return on investment is going to cause these capital financial flows. So ceteris paribus, savings will flow towards the higher returns. So like I was saying, right now the Chinese are earning less in terms of real interest on their assets than you would have in the United States. So the savings is going to go ahead and the savings is going to leave China and it's going to go ahead and enter the United States. So we have a decrease in the supply of loanable funds. We'll call that SLF1. Now this savings that is leaving China is going to be a debit to the Chinese capital account because you've got capital that is actually leaving China. Okay, that savings is leaving China. And you can see here that that's going to push up the real interest rate. That savings is going to go to the United States. So the supply of loanable funds is going to go up from SLF to SLF1. So you can see there that pushed down the real interest rate in the United States. Now, this inflow of savings is going to be a credit to the U.S. capital account. As you can see there, what ended up happening is the real interest rates after the supply of loanable funds shifted in both countries created an equilibrium. They started getting equal to each other. And so that's the idea, is that people in other nations will see where they can earn more money and they'll go ahead and move their savings and their capital elsewhere. Okay, loanable funds will go to the highest return. All right, we're going to go ahead and move on to the next video here.